we are going to start today with what the income tax treatment of cash and securities actually is. So in general, you do not owe income tax on cash when you receive it as an inheritance, but there is a caveat. If what you receive is not simply cash, but rather is the right to receive money due to the person you're inheriting from, it's possible you could owe income tax when you receive this amount. Right? This typically involves items like salaries, bonuses, promissory note payments, which could have been taxable to the decedent, right? The person that you are inheriting from. So if something was going to be taxable to them and you received that income that was going to be taxable to them, then you are going to have to pay taxes on that amount. Okay. The amounts don't escape income tax because of the decedent's death. Instead, you end up paying the income tax as the recipient. So this is a very, very simple situation. But otherwise, if you're just receiving cash, right, as long as you don't exceed that gift tax exemption, then you will be perfectly fine when it comes to taxes. But let's talk about securities, okay? Because with securities, there's going to be what we call a step up in cost basis. And your cost basis is the cost, the prices at which you purchased whatever securities. And in this case, this is the price that the individual who has passed away purchase a security. So when you inherit securities, your receipt of them does not result in income tax. In fact, you receive the added tax benefit in that the income tax basis of the securities gets updated to the fair market value of the securities at the decedent's date of death. Okay, so what happens in this case if you're just receiving, let's say, a brokerage account that has mutual funds or ETFs or stocks in it, right? And though the individual who purchased it and left it to you had some cost basis. Well, when they left it to you, the cost basis stepped up. Now, what does this mean? This means that, let's say, they had bought a stock for $100, right? And now that stock's worth $300, okay? But you inherit the stock, right? And now your new cost basis on the stock is $300, not $100. Now, what does this do for you? What this does for you is that if you continue to hold the stock and it grows, let's say, to $400 a share, okay, and you sell at $400, well, if the cost basis would not have stepped up, then you would have to pay taxes on the gains of each share from 100 to 400, because 100 is what the individual who left the money behind paid for that particular stock. So you would have to pay the taxes on the gain of $300 per share. But since the cost basis steps up, then you're only paying taxes on the gain that is $100 per share from $300, the price at which you inherited it, to $400, the price at which you sold it. Okay, so this is referred to as the step up in basis and can be a tremendous benefit, especially if the securities were purchased at a low price and have increased significantly in value. This applies to publicly traded stocks and bonds. It also applies to interests in private businesses, whether partnerships, limited liability companies, or corporations. Okay, so this can be a benefit that you can receive from inheriting money from somebody else in the form of securities, especially something that they have held for a long time and allowed to grow in a brokerage account for a long period of time. So what does this tell us? This tells us that if we are trying to structure our estate in a way that's going to minimize taxes for those who are coming behind us, then what would we want to do? We can leave them cash. Cash is perfectly fine, right? But we can also leave them brokerage accounts and stocks and bonds and things that were in taxable accounts that have appreciated a lot over a long period of time. And then they could, hypothetically, immediately liquidate those upon receipt, right? And since the cost basis stepped up, right, since the cost basis increased to whatever that price was when they inherited it, right, then they would not have a taxable event or an extremely small taxable event based on the short-term fluctuations between the time they inherited it and the time that they sold it, okay? So this can be beneficial to them, and this tells us that leaving cash and securities in taxable brokerage accounts is not going to be a huge deal when it comes to taxes. Now, what about when you are leaving behind retirement accounts, okay? So not just things that are held within brokerage accounts or just cash. We're talking about securities in retirement accounts. So this is IRAs or 401ks or 403bs or TSPs or any number of different account types. These are typically the most income tax sensitive assets that you will inherit, right? If there are traditional accounts and not Roth, so if you'll remember, traditional accounts mean you put money in a pre-tax manner, meaning you can put after-tax money into it, right? But you get a tax break for the amount of money that you put into the account. So for a traditional IRA, you put in money that you get a tax break on that amount, right? The money grows tax deferred, and then you have to pay income taxes on any money that you take out later on. Okay, so if they are traditional accounts, the account holdings have not yet been taxed, right? The accounts were likely funded by non-taxed income. So like I said, pre-tax income or employer contributions. So like we've talked about before, if an employer makes a contribution to a 401k or 403b or some type of employer-sponsored retirement account, those are going to be pre-tax to you as well. Those are going to be taxable when you retire and ultimately when you leave money behind. Okay, and then obviously there are earnings and appreciation that will also be taxable, but those taxes have been deferred while whoever owned the account held that particular account. Okay. As a result, your withdrawals from the account will be considered income, and you'll need to pay income tax if you're receiving this as an inheritance. Okay, so any money that you take out of any of these traditional accounts will be taxed at your income tax rate. In addition, depending on your relationship to the decedent and how you receive your interest in the account, IRS rules will require you to take withdrawals from the account over a certain period. Your options for inheriting an IRA will depend on a handful of factors. So first, there's if you are the spouse. If you are the beneficiary of a spouse's traditional IRA, there are generally two options that you have. You can either roll over the IRA into your own IRA or elect to treat this IRA as your own. Okay, so as a surviving spouse, you can roll your spouse's IRA into your own IRA if you already have one, right? Then the IRA is yours. You will be required to take withdrawals starting at age 72, and you'll pay income taxes at that point. This is often the preferred choice since it provides greater flexibility in the deferral of withdrawals and resulting income tax and how you can leave the IRA when you die. Okay, because we know at age 72, what comes around are required minimum distributions. These distributions that are required from traditional accounts so that Uncle Sam can get his money and you will have to pay taxes on some of that money and don't just continue to leave it behind and leave it behind and leave it behind without ever paying taxes. Okay, then if you elect to treat it as your IRA, so if you don't roll over the IRA to your own, you can elect to be treated as the IRA beneficiary. Distributions will be required over your life expectancy beginning in the year after your spouse's death or after your spouse would have attained age 72 if later. This option may make sense if you would like to take immediate distributions from the account, right? So two different choices that you can make there, the first being the most common, but either one can be done. Now, what if you are not the spouse, right? Those were for if you are the spouse of someone and you are receiving their traditional IRA. Well, if you inherit a traditional IRA from someone other than a spouse, you generally will need to withdraw all assets from the account and pay the resulting income tax within 10 years of the decedent's death. Okay, an exemption to this rule applies for minor children, special needs trusts, and disabled or chronically ill individuals. And we talked about this a bit in yesterday's episode, right? There's not a set rule for when you need to take withdrawals over the 10-year period. So you can take a lump sum withdrawal at any time, or you can spread distributions over the 10 years. The best strategy will depend on a number of factors, including your income level, other assets, and goals for the funds, right? So you have to know if you leave money behind to somebody in a traditional IRA and they are not your spouse, they have 10 years to take all the money out of that particular account. And then if they are your spouse, then they will have to take withdrawals eventually, right? But they can continue to hold the IRA, right? So it's just a little bit different. And then obviously if it's in a trust, then it has to follow whatever the trust says for the minor child or some special needs trust, whatever it may be, okay? If you receive the IRA as a beneficiary of a trust, right, then you can likely be held in the same rules as the individual and be able to take the money over 10 years. But if it's not seen as a see-through entity, then you will have to take all the money out over a 5-year period. Okay, so trusts are a little different. Then, we haven't talked at all about this yet, but there are also Roth IRAs, right? We talked about traditional, but there are also Roth IRAs. Why do we love Roth IRAs so much? Because the money is tax-free when you withdraw it. Okay, so the rules are different when you're dealing with a Roth IRA or 401k or whatever Roth assets. Since assets in Roth accounts have already been taxed, you generally won't need to pay any income tax when you withdraw from the account. This makes Roth accounts better to inherit, but that's because the decedent saved you the tax hit by already taking it during their lifetime, right? So this is why Roth accounts are so so huge because you can save on taxes in retirement, and then you can leave that money to your children or your spouse or whomever, and they will have no taxes later on. So there is no tax liability there.